Alright, for this video I want to go over the IRS Form 8995A, which is the QBI deduction, and this is the simplified computation. So if we have an 8995A, that's required generally when your taxable income before the QBI deduction is above those relevant thresholds for the year. So for this video specifically, what I want to look at is how do we deal with net QBI negative amounts, and what do we do with the carryforwards? So I've got a 1040 in front of us here, the 8995 for 2021, and then I've got another one for the 2022 tax year, again the 8995 as well, and it's with the full Form 1040. And then we have one slide just covering some general background on this QBI issue and then the fact pattern itself. So I'm not going to go into too much detail on QBI itself. I'm going to assume that you're already relatively familiar with the concept. So again, we're just working within Section 199A. We have qualified business income coming through from partnerships. And so we are going to find ourselves in a position with this fact pattern where we have losses and carryover amounts that need to be reflected in future tax years. So negative QBI amounts can happen in a variety of ways, right? So in our example, we're going to have the taxpayer just has one business interest that has QBI, and so there's going to be a negative QBI amount that has to be carried forward. But you can also have interests in multiple businesses where you're netting the amounts together. Perhaps you have a negative QBI amount under those circumstances. And so when we have a taxpayer that has a qualified business loss for the year overall, right, there's not going to be any QBI deduction for the year. Now, that kind of makes sense, right? If you're operating at a loss that's being included in your taxable income, there is no QBI deduction because you have to have some kind of profitable amount there. Now, when we have negative QBI amounts, these are carried forward to the next year, treated as a separate trade or business, and they're carried forward indefinitely, so they do not expire. You have to carry them forward until you start to use them up by realizing positive QBI in the future. Now, in the year that you have these losses, so these negative QBI amounts, any kind of W-2 wages or U-buy that's attributed to those are disregarded, so they're lost. In other words, the negative QBI amount is carried forward, and it's separately stated on the 8995s. You're no longer factoring in these kind of W-2 wage or U-buy limitations. All right. Now, another really key important point here is when we have QBI losses that are suspended because of other provisions of the tax code. So, for example, if you have a PAL or a passive activity loss suspension, basis rules, let's say partnerships, 704D issues, at-risk limits, things like that. Those losses, because they're suspended and they're not included in your current taxable income, they're not included in your QBI either, right? And so they're only included in that year that you would actually recognize the loss and include it in your income. So in our example here, this is probably as simple as it's going to get. We're not going to have any kind of these issues with passive loss suspensions or basis issues. We're not going to have multiple businesses with complicated netting. Just trying to illustrate how this might happen in practice, and then why it's so important to pay attention to it, because it really can impact your future taxable income if you forget to account for these carryovers. So in our example here, we're going to have John taxpayer is a single filing taxpayer. Total taxable income is below the threshold amount. So we're talking about those phase-ins where we have to account for things like the W-2 limitations and the U-buy. So because he's below those thresholds, he makes under $100,000 a year, he can use the simplified computation. Now, John is a managing member of an LLC that's taxed as a partnership. He actively participates in the business, and so that's important because he's got basis, he actively participates, so we don't have passive activity loss rules, we don't have 704D basis limitations, right? So in 2021, his company reported an ordinary loss allocated to him of $3,090. Now, because he materially participates in the business and he has sufficient basis, He reports the losses as non-passive, and then again, there's the negative QBI amount is going to be carried forward. So if we quickly look at the 2021 return, just to show how that all flowed through. So if I start with Schedule E, so again, his K1 from this partnership showed on line 1 an ordinary loss of $3,090. It's a non-passive loss. He has basis. There's no at-risk limitations. So he's reporting it as an ordinary loss here, or sorry, non-passive loss. And then, of course, that is being flown up to Schedule 1. And then we can see it's being reflected here. So he is including the loss in his taxable income. So it is lowering his taxable income for that period. Now, with respect to what that did to the QBI issue, it's still qualified business income, right? That was reported as such on the K1, and it was included in his taxable income. So he is listing it here in Part 1, right? So he's got the name of the business, the TIN, the QBI, the qualified business income or loss is $3,090. And so his total qualified business income for the period is going to be zero, right? And why is that? Well, because it's negative, right? So we can't have a qualified business income amount. We can't have a qualified business income component if we're going to be less than zero. Now, the $3,090, it doesn't disappear, right? It was included in his taxable income, but for QBI purposes, it has to be carried forward. So the total qualified business loss carry forward reported here on line 16 is the $3,090. So next year, John has to make sure that when he does his QBI calculation, he is picking up this carry forward amount. Now let's go back to the fact pattern and finish this, and then we'll go to the 2022 form and see how all this kind of comes together. So now in 2022, he gets a K1 from the same partnership, but now he's got some profits, right? So they've got $8,060 of line 1 ordinary income, and the QBI amount is for the same amount. So John reports the $8,060 on Schedule E, so it's non-passive income, non-passive profit, and it's included in current income. It's subject to tax. And so now what does he do with the $89.95? Well, the $8,060 is QBI. It's reported on the $89.95. And now for this year, he has to pull forward the carryover amount. So this is John's 2022, $89.95. We can see here he reports the qualified business income or loss for the current period, right? And that's the $8,060. And then we can see here the carry forward piece. So he's got his $8,060. There's the $3,090 coming forward from the prior period. So the net qualified business income after accounting for these carryovers is $49.70. So the component, the 20% QBI deduction, is going to be $994 for the year. Now, conceptually, let's think about what this means, right? So if John forgot the carry forward, right, let's say he left this blank, his QBI deduction amount would be much larger, right? He would have 20% of $8,060 rather than $994. But no matter what he would do, he's still reporting the $8,060 in income. So these are scenarios where it almost seems kind of unfair, right? You're reporting the $8,000 in income. You're thinking, well, I should get a 20% deduction of that amount as my QBI deduction. And unfortunately, that's just not the way it works, right? So you have to be accounting for these carry forwards to reduce your net QBI in those future periods, right? They have to be leveraged. And so this is in contrast to a lot of other things that we think of in the carryover space, right? So carryover negative QBI is certainly to John's detriment, right? As we just looked at, right? It reduced his qualified business income component, it reduced, the amount of deduction he gets, but it's required. He has to do that. And so normally when we think of carryovers like capital loss carryovers, foreign tax credit carryovers, NOLs, these are all good things in that we want to be tracking them and rolling them forward because they're going to lower our taxable income in the future. With the 199A negative QBI carryovers, it's not good. But again, it's required under the rules, so we have to make sure that we are capturing these things, we're rolling them forward until they're being completely exhausted. So that covers it. for this video. I hope that was helpful. If you have any questions, please leave me a comment below. And I look forward to seeing you again on the next video. Thanks.